Welcome to How to Retire on Time, a show that answers your questions about all things retirement, including income, taxes, Social Security, healthcare, and more. This show is an extension of the book How to Retire on Time, which you can grab today on Amazon or by going to www.howtoretireontime.com. My name is Mike Decker. I'm the author of the book How to Retire on Time, but I'm also a licensed financial advisor, insurance agent, and tax professional, which means when it comes to financial topics, we can pretty much cover it all. So that said, please remember this is just a show. Everything you hear should be considered informational, as in not financial advice. If you want personalized financial advice, then request your wealth analysis from my team today by going to www.yourwealthanalysis.com. With me in the studio today is my colleague, Mr. David Franson. Thanks for being here today.
Yes, glad to be here.
David's job is reading your questions, and I'm going to do my best to answer them. Now, you can send questions in at any time by texting them to 913-363-1234. Again, that's 913-363-1234. Or email them to heymike@howtoretireontime.com. Let's begin.
Hey, Mike, if someone wanted a part of their retirement income guaranteed, what should they know as they shop around?
Okay, so yeah, most, this is kind of funny, and this is all over the country. Most dinner seminars you're going to hear, even a lot of these educational events at libraries, a lot of them are really focused on selling an annuity. That's not wrong, but we also want to be cautious of the sales pitch or the preference towards selling a single product. So, David, if you were to build a house, could you do it with just a hammer?
I would need more than just one hammer, yes.
Sorry for the leading question, but
All right.
An annuity, specifically income from an annuity, is just a tool. Admittedly, I wrote an entire book to try and convince people not to do the income annuity, but I still have people that come in every now and then and say, I just won't sleep at night unless I guarantee a part of my income. Fine. As long as people know what they're giving up in return for what they're receiving, I'm okay with that. Would I personally do a guaranteed income stream? Personally, no. But I'm not you listening right now. I'm not everyone that's out there. Let's have some fun. This is how you vet, based on my experience, based on my opinion, on how to really vet income annuities. So annuities that are intended to provide income. You got three options. You've got your variable annuity. So there are higher fees associated with it. It doesn't have protection. It's just whatever the market does, and you buy into it and so on. And at some point you turn on the income. And really the only place I see that even being relevant is if you have a bunch of after-tax funds, you want risk with more growth potential, and you want to kind of shelter all the taxes. But I've never actually sold a variable annuity in my 10 years of doing this. It's such a weird situation, but that's the variable annuities, what everyone talks about. Annuities are bad. Look at these variable annuities. Well, it's not the full representation of the annuity space.
Maybe they're varying too much and people don't like that.
The thing that gets me is, why wouldn't you just put it in the market, have less fees overall, and then when it comes time to draw income, you just buy a different annuity and then turn on the income? But I digress.
Yeah.
There's probably a reason why I haven't sold one. But and it's funny too. Hopefully everyone here is going to smile at this. I'm saying the financial swear word right now, annuity. We're talking about it.
Oh.
So, okay. There's fixed annuities, which grow at a fixed rate. And then there's fixed indexed annuities, which grows based on an index. So it can go up in value, or if the markets go down, it wouldn't lose anything. So it's principal protected. Some of them have fees, some of them don't. There's a lot of very polarizing opinions about this. And almost always when I read them, they're leaving out some key components to their argument to just make their case, which I find is very disturbing. Again, my book, How to Retire on Time, was written to say why you may not want to do this, but we got the question, so we're going to try to address it. So why would someone opt in for guaranteed income? What regardless of the annuity bought, why would someone do it? Well, there's three ways you could take income from an annuity. So the first one is if you have a lifetime income rider. That means you are guaranteed income for life. Not all annuities guarantee income for life. This is a common misconception. Okay?
So there's no cap. You could be 102 and still be getting it.
Yes. Well, I shouldn't say yes with a blanket statement. Look at the details.
Okay, sure.
They can do whatever they want in these contracts. But generally speaking, the idea is if you can pull enough people together, most people will die off soon enough that the insurance companies will still be profitable, and the few people that live a long time, it's fine.
Yeah.
That's the idea behind it. So you can guarantee income for life. That's one way to do it. The other way, this is the more technical term, is annuitization is not guaranteed for life. It's that you're going to grow your money to a certain point, and then you're going to annuitize it, which means you're going to get a fixed payment for a certain period of time. So maybe you annuitize it and you have equal payments for 5 years or equal payments for 10 years. Okay. That was the original kind of annuity setup, is it grows at a certain rate and then it pays for a certain period of time. So this is very important as you're shopping annuities. You need to understand, is this an annuity that's going to offer you lifetime income? And do you want that? Or do you want that guaranteed period of time? Or some people will just say, I just want protection with some growth potential. And they take out 10%, which in many annuities, you can take out 10% penalty free. But that's kind of nice because it can grow. It can't go backwards. So you're kind of preserving assets in that sense.
Sure.
The problem, though, is if you're taking out 10%, well, if it's growing by 6% on average, let's say, and you're taking out 10%, the amount you can take out each year is going to go down. So you got to be cautious of that. Devil's in the details.
Yeah.
So, okay, we've talked about kind of different ways you could do income. A few other things that are out there. For the lifetime income side of things, you have flat income. So flat income, by definition, is you're going to get a certain amount for the rest of your life. It does not change. So it looks great for the first couple of years, but as inflation continues, the buying power of that income stream goes down. So you're going to be very careful to not just go all in on flat income and expect everything to work out, because you might end up being that older person in your late 90s that's living off a fixed income, and it's just really hard to make ends meet because 30 years of inflation can really do some damage. Then you've got your guaranteed COLA, or cost of living adjustment. So let's say you buy one that is going to pay out X amount of money, and every year it's guaranteed to increase by 3%.
Okay.
That sounds nice.
Right. It does. Sounds really nice right now, but...
but...
Is there a detriment here?
The benefit's going to go away once the cash value that it is associated with is gone. So an annuity is going to grow or increase based on the cash value. Okay. So as long as it's growing, the benefit stays. But a few bad markets, and the cash wasn't able to grow enough, maybe after 20 years, that guaranteed, quote unquote, guaranteed COLA would in theory go away.
Then it would transition to like a flat income, or?
Yeah, very close to flat.
Okay.
I mean, it might go up just a little bit, very insignificant. And this is a very broad statement. There's always exceptions. Look at the details, right? This is kind of how you're shopping it, though. And then an option that I don't think is discussed enough is, and I actually asked someone this, I said, why don't people talk about this one? And the answer I keep getting is, well, it's more confusing. So people just kind of shy away from that.
Yeah.
That's anecdotal evidence, but that kind of shocked me a little bit.
Yeah.
So indexed income. So your income starts at a certain rate and it's tied to an index. So if the index goes up in value, your income goes up. If the index goes down, it stays the same. So just for easy math, let's say you buy an annuity and it's going to pay out $50,000 a year. Just easy math, okay? And the markets go up, and so in year 2, it goes up $53,000. Let's just say. Okay, so now you got $53,000, and then in year 2, the markets just tank. So the next year, you get $53,000. You don't go backwards. So the reason why this, I think, is kind of nice is it gets rid of less risk to an insurance company in some sense, because it's not guaranteeing an increase each year. It's more of, if the markets go up, you have some up. If it doesn't go down, it just stays the same. But just like the other option is, if the cash value goes away, this index increase would also go away. So nothing's perfect forever.
Yeah.
Right? Now, regardless of those three options, flat, guaranteed, or indexed income, you can, and this is often not understood, you can take IRA funds, an individual retirement account, pre-tax, or you can do the Roth, and still make it as quote unquote joint income. So, David, you're married.
Yep.
Let's say you take your IRA, you buy an annuity, and you were to pass first. Even though the IRA was in your name, the payments could continue to your wife's name.
Okay.
You can set that up, but if you do joint income, your overall income would be less than if you just did single, because whenever you do joint survivorship or 100% survivorship, there's just more risk to the pension, the insurance company, whoever it is. And that's pretty common. Now, here's where it gets a little bit more technical. You've got riders and benefits. You can do all sorts of things with annuities, but just like a car, if you want a nicer, more luxurious car or experience,
Yeah.
you're going to pay for more features. If you want a quote unquote higher quality or a better experience with annuity, you probably would be paying for some features. Nothing wrong with that. It's just know what you're paying for and why the fees would be there. So here's just a couple of things that people may not realize. There are certain things out there, like some annuities will offer you, I'll use the 50,000. Let's say you buy an annuity, you turn it on, 50,000, it's flat for the rest of your life. But if you were to get sick, maybe you can't do 2 of these 6 activities of daily living, then your income would double for a certain period of time. That's kind of nice.
Yeah.
You don't have to qualify for health care or anything like that, or any sort of health exam for stuff like that. But many times you're either paying for it or it's baked into the overall illustration or product itself. Nothing's free. Insurance companies aren't charitable. They're running a business.
Yeah.
They just operate within the insurance space.
Right.
So there's all sorts of benefits there, but you're going to pay for it. You just got to understand that. And then the thing about annuities and the income streams is if they're going to guarantee the income and some sort of benefit, the insurance company, and this is kind of speculative. I don't mean it to be, it's not defamatory. It's just, let's just realize what it is economically. They don't really want the cash value to grow for a long time. They want the cash value to go down because if the cash value associated with your income hits 0, then guess what? They don't have to pay your beneficiaries anything. So a lot of these indexes don't have necessarily high growth potential because they're built for higher income, lower cash value, and they hope you die soon enough that they don't have to give out any money. Now, when I say you need to live within your emotional and economic limits, an annuity may make more sense from your emotional limits. Maybe not economic limits, but emotional limits. And if that's the case, I'm okay with that. And I want to say this because this is cliche and probably not politically correct to say, but whatever. Females tend to gravitate more towards guaranteed income for life because they know that they're going to probably live longer than their spouse,
right,
in the traditional marriage sense. And I kind of cringe when I say this because I don't agree with it, but many females in a traditional marriage were not involved with the finances. They had the husband just do it. I would hope that all marriages, both parties are actively engaged in, the finances and the decisions and the strategies being used, but that the reality is that's just how it is. Okay. So many females will gravitate towards, I want guarantee because when you're gone, I won't know what to do.
Sure.
Many males are more willing to take risk because they've been doing it so long.
Yeah.
So there's also a blend of couples therapy here.
Yeah, right. Wow.
In that sense that you
Who
have to
knew?
really navigate. Again, I want to reiterate, would I personally buy an annuity and turn on the income stream? As of right now, based on the current offerings, no, I wouldn't. But I'm willing to take more risk. I'm willing to use the reservoir strategy and have a portion of my assets in principal protected accounts. So when the markets go down, I just take income from there because I have faith in my models. I have faith in the market that it will recover and I'll be fine. I have faith in that strategy, but I know not everyone's in that boat. So hopefully this is a more candid conversation of, look, here are the options. It's out there. It's just a tool.
Yeah.
Doesn't make it good or bad. It just, when I go to a restaurant, I buy something different than my wife. We look at the menu, we buy 2 different things. Let's not disparage or condescend on people that are buying one product over another. Let's just accept that we all have different preferences and have an open conversation that supports whatever that preference is.
Yeah, sounds fair.
Could I say that more clearly?
Well, you got it.
The hard part is when you talk to someone that has a preference of putting you in the market or putting you into an annuity, that's the hard part. You got to find someone like Kedrick, shameless plug.
There you go.
that really tries to take an indifference in the matter, explains the benefits and detriments, and then just lets you make the decision based on what is right for you. That's really the goal. That's all the time we've got for the show today. If you enjoyed the show, consider subscribing to it wherever you get your podcasts. Just search for How to Retire on Time. Discover if your portfolio is built to weather flat market cycles or if you're missing tax minimization opportunities that you may not even know exist. Explore strategies that may be able to help you lower your overall risk while potentially increasing your overall growth and lifestyle flexibility. This is not your ordinary financial analysis. Learn more about Your Wealth Analysis and what it could do for you regardless of your age, asset, or target retirement date. Go to www.yourwealthanalysis.com today to learn more and get started.